Says broadcasting, still says it.
You could start when
All
you're
right.
ready.
Okay.
Okay,
Yeah, there's participants and it says recording.
great. Good afternoon, everyone, and thank you for joining us today for the 2020 Midyear Economic Overview presentation. We're looking forward to hearing from Steve Biggs, our Chief Investment Officer, on his thoughts about the future of the economy and the markets in general. We'd love to hear your questions, so please go ahead and send them using the Q&A icon at the bottom of your screen. Steve will answer them at the end of his presentation. This presentation will also be available next week and posted on our website. Thanks again for joining us today. Steve, I'll turn the presentation over to you.
Well, thanks, Andy, and thanks everyone for joining us. This format is a little different than what we're used to, of course, as we're doing it virtually. We don't have quite the interaction, but we did want to get everyone involved. So we've got a couple polls to start off, make sure everyone's paying attention. So we're going to start. First question. So at the end of this year, do you think the S&P 500 will be higher, about the same, we'll say about the same, or lower? You give it just a minute or two to Okay, I think that is. So lower is the winner, not that optimistic group, and a pretty well split between lower, higher, the same, but only 27% say higher. So that's interesting. And let's got one more question for you. And that's on interest rates. So we pushed this out an extra year. Interest rates are very low now. So we're going through the end of 2021. Do you think interest rates will be higher, the same, or lower? Okay, so it looks, and that's so the same as the winner there, kind of leaning towards higher. Not too many people voted lower, but of course the interest rates are pretty low at this point, so it'd be hard to go too much lower, but it certainly has been, certainly Europe has lower rates, so it wouldn't be unprecedented. Okay, so let's start the presentation. And do you want to get as many questions as possible? We're going to try and go about half an hour. It might go a little bit over. And there's a Q&A button. If you type your questions during the presentation, when you have them, we're going to kind of sort through them and get to them at the end and try and answer everyone's questions. If something important comes up during the presentation, maybe technical difficulties, you can raise your hand and we'll try and get to that. So hopefully everything is clear here, but if one of the slides doesn't make sense, you might want to maybe just a couple of people raise their hand and we can address that at the time. So the agenda for today, we're going to review what happened in the first half, pretty eventful first half. Going to go into what we expect in the second half of the year. We're going to touch on the government stimulus and the impact it's had on the economy and financial markets. We're going to go into stock performance and the outlook going forward. Going to talk a little bit about the election coming up And then there's the questions and answers at the end. So to start, I just wanted to review some of the major economic indicators, that are published. Not go through too much depth, but the big ones that we look at. And the interesting thing, a lot of these, you really have to look at pre-second quarter 2020 and then included on the second one. So a lot of these have two charts because the difference is so great that it's kind of hard to read the rest of the chart. So gross domestic product, the total output of the economy, this data has been tracked on a quarterly basis back to 1948. So here we see the numbers through 2020, or January through 2020. Fairly steady, generally growing. We've had the bad quarter is -3%, -4%. Back in the global financial crisis and then post-World War II. So if we add, so that's where we were at. If you add the second quarter of 2020, that number is -32%. So by a long shot, the worst since this has been recorded. That's an annualized number. So we would need that number for 4 straight quarters to see a 32% full decline for the year. So this is expected to bounce back in the third quarter of the year, not to the extent that it pulled back, but we are expecting a pretty solid bounce back as things reopen. If you go back to the Great Depression, that number was about 32%, but that was for the full year. So certainly the worst number since we've been keeping track of this. Another one we look at, initial jobless claims. So this just shows who's filed or who's seeking unemployment benefits. Again, the previous record has been around 700,000. That's kind of early 80s. And again, during the global financial crisis, if we pull that forward into March, this is a weekly number, hit 7 million early in March. And you can see that has come down pretty significantly, but it's still running well above previous records, and a little bit concerning that that's started to tick back up. So, we expected this number to come back down, and as people went back to work, that that unemployment initial jobless claims would continue to decline. We started to see a tick back up in that. And then another very closely watched indicator is monthly jobs created. In this 2008-2009 timeframe, the global financial crisis was the previous record. So losing about 800,000 jobs a month during that time period. And then you get a rebound, but it takes a while to recreate those jobs. It takes time to recover. Once we add in March of 2020, that's that big decline. That's over 20 million jobs lost. And the good news is we've got record high numbers of jobs created after, but as you can see, that's substantially less than what was lost. So, we'll get another number on this on Friday. We'll get the July number. It's been pretty hard to predict. So June has been above, certainly beat expectations with initial jobless claims going back up. There's thought that this may not be such a good number. We could, in fact, maybe see job losses during the month. So we'll have to stay tuned for a couple of days, see what happens there. So unemployment. So did hit a very high level there at 15%. Again, that's historically high record outside of the Great Depression. That came back down to 11%. We'll get another number again with the jobs report. But there's might be some misleading data or some confusion in this number. So they take a survey basically mid-month to determine unemployment. So that June number at 11% is how many people say they're unemployed. There's about 23% of the workforce receiving unemployment benefits. So, there's a chance that this is picking up some numbers. For example, people that are getting paid because their company received the Paycheck Protection Program loans still paying their employees to sit home. So that technically is not being employed. You're not working. So, and then there's people that got furloughed that say they're supposed to come back, but we don't know for sure. So I think the unemployment picture is still pretty murky right here. So this number is up for some debate. The other thing we kind of look at, so we've seen, so what these numbers all show us is that we had a historically high drop, a big drop in the economy, and then a nice bounce off the bottom. Things have been recovering pretty quickly, not back to where we were, but headed the right direction. I think what's a little more troubling, what cause for some concern over how big that rebound is what we call high frequency data, and that's really things that we can monitor on a daily basis. So this is all kind of new as far as the economy goes. So this information, we're getting at seated dinners, that's straight off the Open Table website. So we can tell how many people are going out to dinner versus the month before or prior year. So you can see that drop off is basically 100% beginning of March. Nice rebound as things start to open up into May, but that kind of leveled off and hasn't really moved, maybe even trending slightly down as we get into July. This is TSA checkpoints 2019 versus 20. So this is published on the TSA website and published daily. So you can go see how many people went through TSA checkpoints yesterday. Again, huge decline early March, nice rebound, but really kind of leveling off at 80% less than the prior, than last year. So that's still a pretty big drop off in the economy. So, we may see kind of a stalling out in some of these data points that we have seen a bounce back on. So that's something we'll figure out over the next coming months as we get some of this data published. This is from the Yelp website, and this is concerning because what it shows, that yellow area is, well, total number is businesses listed as closed on Yelp. So yellow is listed as temporary closed, and that greenish area is listed as permanently closed. So while we see the number of businesses closed slowly declining, the numbers of permanently closed are increasing. So the problem is this drags on, more and more of these businesses are likely to call it quits. And a lot of these are small businesses. So a lot of the stimulus money is easily given to large corporations, but harder to give to kind of small sole proprietorship, smaller businesses. And these are jobs that, could take a long time to recover if more and more of these close. For example, if restaurants start closing, I don't know how many people are really looking to go out and open a new restaurant right now. That might come several years down the road, but it'll take some time to recover some of those jobs. And that could drag the recovery on much longer than we would like. So, by the end, the problem is once we get past the point where the government's supporting the economy with stimulus, we still could have fairly high unemployment, which is going to be a drag on the economy. So that's kind of a longer term concern. I think, I've heard studies as far as what we could expect as far as restaurant closures, as maybe a third of all restaurants are out there now. So it could be a pretty high number. So clearly what we really need is a vaccine to kind of get back to normal. And this is actually a Morningstar table just showing where the early candidates are as far as trials and potential release date. So we've got several candidates, and probably not all of these will get through, but there's a number that are expected to get approval either late this year or early 2021. I think the Moderna and the Pfizer are the two leading candidates. and then followed by a number in early 2021. So I think it's feasible by the end of next year. There's enough doses to immunize enough of the population that things could start returning to normal. Obviously, this is still a very new technology and very, hasn't really been used before to put together a vaccine. The previous record, I think, was 5 years for an Ebola vaccine. So this, we're talking less than a year. The other thing, we do get a question, what stock do we buy to make money from the vaccine? Really, this is, there's a lot of government funding in here. There's not expected to be much profit. So J&J just announced this morning that I think the deal for 100 million doses of vaccine by the end of next year. And that was the price there. It was $1 billion at $10 a dose, which is not really profitable for them, but they did receive a significant amount of government funding for that research. Pfizer, pricing around $19, and they did not receive government funding, so they will make a profit, but it's probably not that significant as far as all things go. So the government stimulus, the most significant thing, in Congress, the House and the Senate worked very quickly to get this together, passed in a matter of days versus months when we went through the 2008, 2009 crisis. And some of the key things in this are the $604 billion for individuals. Most importantly, $600 extra weekly unemployment payments. So that's, along with the $400 from the state, that's about $1,000 a week, or around $50,000 a year from unemployment. So that's a significant support for people that have lost their jobs due to this. Other very significant thing is the Paycheck Protection Program, the $350 billion in loans for small businesses. So, that helped. And under that, the loan is forgiven if you use it to maintain paychecks. So that helps a lot of people get paid that otherwise would not, because the business is not, generating enough revenue under the shutdowns. And then there's other things in there. There were the cash payments to $1,200. There is money for large corporations, including the airline industry, and then state and local governments, public services. So the problem is a lot of this is starting to expire. The unemployment payment expired last Friday, so they are currently working together to try and extend that. But cooperation isn't there, like the emergency situation we had when this first happened in March. So no agreement yet, and it does appear that they are quite a ways apart on some kind of agreement between the Democratic House and the Republican-controlled Senate. So this is something that that could have a pretty big impact on the economy over the next over the coming months. I think at this point we are in a very deep recession, as you can see from the data, but most people haven't felt it, and that's because of all this government stimulus based on not just the fiscal stimulus from the government, but the monetary stimulus from the Federal Reserve, which we'll get to that next. But it's stock prices are up. We don't really notice a difference, and I think that's all the support that has been given so far. I think $2.6 trillion in the CARES Act, and now there's a very big debate about how much the second round should go. So this is the interesting thing here. This is personal income, basically percentage change in personal income. So once this CARES Act went through, we saw a huge increase in personal income, and that's because a lot of people that lost their jobs in the frontline kind of workers, a lot of hospitality, things like that, restaurant, tend to be lower paid workers. So they were actually making more under the unemployment benefit, which was $1,000 a month. And that's part of the debate that's going on. So it's possible that the additional $600 a week overshot, what they needed to do to support those workers. But the thing is, it is a big support for the economy. If you're making less than $50,000 a year, pretty much every dime you make, you're spending, and that goes straight back into the economy. And you probably don't have a big amount of savings to fall back on if you don't have that job or you don't have the unemployment support. So this money going straight into the economy. If it were to fall significantly, that could certainly have a big impact on spending. So, income should mirror spending to some extent. You can live off credit cards or savings for a while, but at some point it has to be close. So, as far as the Federal Reserve goes, this is the Federal Reserve balance sheet. And if we look to, typically they didn't really carry a balance sheet. We go back to 2008, global financial crisis. This is when they started this quantitative easing kind of experiment that they've been doing. And they started out by buying treasury bonds to keep interest rates low, and they bought mortgages because that was the troubled part of the market. So the purpose of this was to keep rates low. The Fed determines short-term interest rates by the federal funds rate, and that's the federal funds rates generally going to control very short-term interest rates. They don't really, market forces are more in control of longer-term rates. So they were in there buying treasuries to keep rates low, because that drives demand for treasuries, drives prices up, which drives interest rates down. And that was really the purpose. They started to unwind that balance sheet in 2017 when the things started to look stronger in the economy. So that came, there were 3 tranches of quantitative easing during the financial crisis. This time they just said, okay, we're unlimited, and we're not only going to buy treasury bonds and mortgages, but we're also going to buy corporate bonds, corporate debt, including non-investment grade, so junk bonds, and we're also going to buy stock to try and support the market. So they're buying bonds to keep rates low, and they're buying corporate bonds and corporate stocks to support those markets, essentially keep prices higher. So, companies have certainly figured this out. On the debt side, we've seen a lot of new debt issuance by corporations because the markets are very favorable. I think it was Alphabet or Google just this week issued 40-year bonds. I believe they're paying about 2% interest on those. So pretty good deal for the companies. It's not clear that they have actually bought a lot of corporate bonds or stocks, but certainly having the support in there helps the market. There's certainly a sentiment on trading desks to buy what the Fed is buying. So they've got a lot of assets that come in there and support prices. And that's certainly, I think, a big driver of what we're seeing in stocks. So this is the stock market for the last 24 years, going back to 96. And you can see we had that kind of rally bull market into 2000, decline, slow recovery, decline. And I think what is kind of startling about this is the speed of the decline. It's the fastest bear market in history, and then the speed of the recovery. So then it was the fastest bull market in history. It was, if you blinked, you missed it almost. It was very hard to kind of catch the bottom of that. So what does that do to valuations? This chart, and I've shown it before, shows forward PE multiples or price to earnings multiples on the S&P 500. So you take all 500 companies, figure out what they earn. That's the level of earnings of the S&P 500, and you just divide the value of the S&P 500 into that. So this shows as of July 27th, the market's trading at 22 times forward earnings, 12-month forward earnings. And if we look to see how that compares to other times, I mean, that's a pretty high level. You'd have to go back to the late 90s, that 2000, the dot-com, the tech bubble era. So that's how expensive it is. And if you go back to 08, 09, you see that very low level. That was during the global financial crisis. So in theory, stocks are forward-looking. They should discount in forward expectations. So we could say that, 21, there'll be a vaccine and we'll get back to normal. So 22 will be a normalized year on earnings. So stocks, maybe they shouldn't trade at depressed earnings levels. Maybe they should trade at that normalized level, which makes from an academic sense, that is what they should do. That's what you learn in business school. But that, if that were the case, it would be the first time, because if we go back to 1998, 1999, they were trading at historically high PE levels, very high valuations on peak earnings. On this, we knew earnings could not grow that fast forever. So they were still trading at higher valuations. In theory, they should discount that in and say, we're not going to grow this fast. Same thing in 2008, you're trading at 10 times earnings on depreciated earnings that we knew in a couple of years were going to recover. So that's what leads me to believe this is more largely the result of the stimulus has been driving stock prices rather than the market actually getting common sense and doing what it's supposed to. Because if we look at earnings expectations, this is what we see is a big 23% drop in 2020, a nice increase in 2021, but not enough to get you back to 2019 levels, where we start to make new highs is 2022. So still a couple of years out, and I think if you buy stocks at this level, you're going to get to that level again, and they will seem, the prices will be normal. I think the risk here is that that's already been priced in. So, it kind of takes some of the upside off the table. And with those low earnings multiples, there's not as much of a floor if the stimulus fades. So we still expect continued volatility. And I do think there's some risk to those 2022 numbers. I mean, we looked at the business closings, and we do think unemployment may stay a little bit higher than you would think otherwise. When this was, we're going to be back in 2 months, everyone can reopen, more jobs come back. But it's, as this goes, if we're really looking a year out until people start going to restaurants, airplane, travel, everything like that, we could have some high unemployment around for a while, and that stimulus is going to gradually be backed off. So one way that stocks look fairly cheap is if you compare them to a bond. The blue line on this chart is the 10-year Treasury yield, so government bonds, and the green is the S&P 500 dividend yield. And for the first time since the 1960s, you can make a better yield buying stocks over bonds. And if you buy stocks, you do also get some appreciation potentially. You get the growth of the company. So we still think the companies are going to grow. Maybe it take a little while for the stock price to catch up, but we do feel that they are going to grow. So that could give some support to stocks. If you are actually seeking income, that's a better way to go. And this dynamic could hold for a while. It certainly did in the 50s and the 60s, and it's possible that the Fed does keep rates artificially low. You'll hear the word financial repression, and we'll probably get a lot of, as we get past this, we'll spend a lot of time talking about deficits and debt and the effect on the economy and repaying them. But the last time, it looks like we're going to come out of this with a debt about what it was similar to World War II. And the two ways to reduce debt is to save more or tax more and spend less. That's doesn't really happen in modern economies. The real way is to keep inflation high, and so Fed could keep rates artificially low, keep inflation a little higher, and basically inflate your way out of it by making the currency you're repaying those debts with worth less. So, we're a while. It's going to be a while before we have inflation and rising rates, but we could see it. We could come out of this with an elevated inflation level, just because the level of debt we'll have coming out of this. But not something to. Bigger concern is the economy right now, but something to look forward to. And while the market is up significantly, the breadth is not good. It's driven by a handful of stocks and a handful of sectors. So technology, consumer cyclicals, healthcare, they've all done well. And they've supported the market. Not the average stock is not doing that well. And certainly if we look at the more cyclical sectors, industrials, real estate, financials, they've been hit pretty hard in this, and they are responding like we are in a recession. So they're priced in a recession. Energy too, down 37%. That's got some technology headwinds as well. But all these sectors are cyclical and generally considered value stocks. When we do recover, these sectors are likely to outperform. We feel will outperform some of the sectors that we love now, like technology and consumer. And I think what really illustrates this is, sorry, this chart's a little bit blurry, but the S&P 500 is a market cap weighted index. So each stock is weighted by the value of the stock. So a larger company carries more weight in the index. So right now, the top 5 stocks in the index actually represent about 23%, almost a quarter of the index are represented by 1% of the stocks. And they also represent 16% of the earnings. So not pulling their share on earnings, but still not too bad. We've only seen this really before. You have to go back to the 1999, the tech bubble, where they got up to 18%. A little bit of difference though. In the late 90s, everything was up. The 5 stocks were just up more. We're getting more of a divergence this time because we've got stocks that are up significantly and most of the rest of the market is down. In fact, if we just weighted everything equally, all 500 companies, the market would be down over 8%. And instead, as of the 24th of July, at least, it was pretty flat, actually up slightly. And these are the big 3, Microsoft, Apple, both over 5%, Amazon is pushing 5%. We've got Alphabet / Google, and that includes both share classes, and then Facebook. So, so I don't feel it's sustainable that these stocks maintain such a high weighting in the index, but it's not necessarily that they come crashing down like we saw in 99, going, after 99 going to 2000. It could be that they, decline slightly and the rest of the market comes up and gets to a healthier scenario, but we don't think it's sustainable. And the other thing you have to think about, if you're buying an index fund based on the S&P 500, you almost can't even call it a diversified fund under the SEC guidelines, because some of these weightings exceed the cap limit that a diversified fund is allowed to hold at 5%. So so there's some risks of just owning index funds at this point, because you're unintentionally owning a concentrated, basically tech portfolio, even though only a couple of the, Facebook is, Alphabet and Amazon are not technically in the tech sector, but we'll call them tech-ish. So, so we think that's a risk, and what could hurt some of these stocks. I mean, in some cases, the valuation we feel has gotten excessive. So there's probably some downside, or at least caps some of the upside. It's hard to get, once the stock exceeds 5% in the index, it's hard for it to get much higher, because most mutual fund managers cannot buy above 5%, limit as to still own a diversified fund. So the incremental buyer is probably more likely a retail purchaser, which only has so many assets that they're working with. So you don't usually see a company stay above 5% for that longer. The other concern here is, even though all these companies look good and healthy, that there's some antitrust concerns. I think both parties both Democrats and Republicans have some concern over control these companies exert in their markets. So, Alphabet basically owns online advertising. They acquired several companies to build that up, Microsoft and actually Amazon. The two of those basically control cloud infrastructure. Amazon obviously has large retail exposure. I don't know that would be raised too much alarm. It's more the back end. And then, of course, Facebook owns the social media space. So 1999 is the last time we had such a concentration, and just got to show, I don't know how well you all remember 1999, but according to Billboard, some of the top performers of the decade, or the late 90s, we had Destiny's Child with Beyonce, Spice Girls. Carlos Santana had a top 20 single, and so did Britney Spears. Top 5 stocks back then. Microsoft is the returner. So they didn't maintain that the whole time, but the top stock, top market cap stock then, and still good now. The other ones, General Electric, Intel, Cisco, ExxonMobil, all had some good years. And then if you look, the returns since then have been not quite as good. So Microsoft annualized for the last 20 years, 6.2%. General Electric down 10% almost per year. Intel and Cisco fairly flattish, and as is ExxonMobil. So, GE and Exxon were clearly the Spice Girls and Britney Spears of the companies. If we look at the other ones, Microsoft, I think that's the Carlos Santana, because they had to reinvent themselves to stay on top. In 1999, Windows was their most important product, $8.5 billion in revenue. In 2020, it's the cloud business, and that's $40 billion in revenue, growing at 25% per year. So really a much different looking company than they were before. So if, thinking of products, someone like Apple, if they were to stay dominant in the index, they would really have to, we probably don't know what product that's going to be. They would have to reinvent themselves. And then you take others like Cisco, I think an Intel would apply to this, and they are more like the Beyonce of the group because they kept growing, grew revenue at average annualized rate at 5.5%, earnings per share at 11% since then, which is great earnings growth. But their stock is actually down slightly since then, and that's what we call multiple compression. So that's why you need to be careful what you pay for stocks. So some of these stocks that have driven the index are probably getting a little too pricey, and we think there's probably better opportunity elsewhere. One of those places is international. So non-US stocks, largely Europe, Japan, had a hard time really recovering since the global financial crisis. Previously, they had tracked pretty closely on valuations and returns, but purple down there is non-US stocks. We see have not had the bull run that we had over the last 10 years. So, why are some reasons that they could outperform? As new weekly coronavirus cases, the US has improved since then, since this was printed, but it's clear that other countries have done a much better job at getting the virus under control, so they can open up faster. They send the kids back to school so the parents can work. There's a lot of reasons that the recovery could start much quicker in other countries, such as Europe and Japan. So you think there's opportunity internationally, and the dollar is weakened too, is largely because of this. But we think international has some better opportunities. So that's what we'd be looking for going forward. And then we have an election coming up. So normally, if we had an election year, and we're talking in September, 3 months out from the presidential election, this would dominate the talk. Obviously, it's a much smaller piece of the equation right now, and I think things can change in 3 months, but Joe Biden is, I think we would say, a clear front runner at this point. The bigger question is really what goes down in the House and the Senate. I think the House is fairly well believed will stay Democrat. The Senate is, if we had looked at the beginning of the year, no one thought there was a chance that the Democrats could take the Senate. That's actually looking more and more likely. So, so that's probably the biggest question mark going into the election. How it affects stocks. Well, I know there's a theory that Republican presidents are more business friendly, so therefore the stock market should do better. That hasn't really been the case. It's a little more mixed. Actually, slight edge goes to Democrats. We've got Clinton and Obama the best, and Nixon and Bush the worst. But there's a lot of other factors here, right? It's not just the president. It's and it's whether you start after the election, but the Congress makes a big difference too. I mean, the best returns seem to be when there's split powers. So one party controls the presidency and another party controls either the House or Senate or both. And the reason stocks do well then is, markets like certainty. And the one thing you can be certain of is you have split parties, that nothing will change because nothing will get done in Washington, and probably no new laws, no tax changes. I think if we do see Democrats, Joe Biden as president and Democrats in both the House and the Senate, I think they're going to be, originally, we're talking 21, they're going to be focused on reviving the economy. Joe Biden's pretty moderate, of course, candidate. So I think they're going to be pretty friendly towards the economy. At some point, you could see an increase in corporate tax rate. I mean, that went from 35 to 21%, which a lot of people at the time thought was excessive. I think there's a talk of a 28% corporate tax rate. So that would be a direct hit to savings, could hurt stock, or direct hit to earnings, could hurt stocks. But over the, that's not a dramatic increase. And at some point we need to pay down the deficit anyway. So I don't think the presidential election will have a huge impact on markets. I think there's much bigger factors at this point. So inclusion, historically sharp decline in economic output, 33% drop in GDP. We've had a big rebound, but this may stall, and we'll have to see in the next few months. Risks, usually we're showing risks that may hurt the economy slightly here or there. The economy's about as bad as it can get it. I think the risks now are more on what happens to financial markets, and I think a lot of that will be driven by stimulus. So a lot of risks out of Washington, and then longer term, obviously we have to look at deficits and higher debt that could lead to slower growth and economic repression. In the intermediate term, really, I kind of 1 to 2 years out is how bad the permanent job losses are. So that's something to look at. As far as stocks go, we're concerned about the concentration in mega cap tech or momentum names. Not as bad as 2000. So in 1999, I was co-managing a large cap growth fund, and I oversaw tech, and this is much different, but there are some similarities, of course, that bear some watching. We do think there's better opportunities outside of the US, and we do think cyclical and value stocks, as we recover from this, will outperform the growth part of the market. But it may be a little bit early to get too excited about that. So that is the presentation. I think let's get to some Q&A here.
Steve, we have a few questions. First one is, clearly these are unusual times, maybe unique from an investment perspective, but assuming a slow recovery, let's assume staying where we are for now for unemployment and business outlook, how should we invest?
That's a good question. So, yeah, I think stocks as a whole, there's still opportunities there, and we're very skewed by these large mega cap names. So I think if we can look more to value, we'll probably increase international. I think you need to continue to look at non-correlated assets such, alternatives. So some of the other strategies we've put in there, and even real estate. So, real estate's gotten hit pretty hard too. So some of the headline numbers are skewing some of the underlying parts of this. So I just say, I would say stay diversified. I know there's a temptation to move over to bonds because stocks are high, but bonds are not giving you much too. So I think stay diversified and stay the course.
What's the difference between the jobless claims and the unemployment percentage?
So jobless claims they're initial jobless claims. So if I were to file for unemployment this week, I would show up in this week's jobless claims and then the unemployment number. But and then as long as I was unemployed, I'd show up in the unemployment data, but I wouldn't be making a unemployment claim every week. So that just captures the initial ones. So as those tick up, that's why we wonder if that unemployment number is going to start creeping up as well.
Please explain how the market could be doing as well as it is, considering super high unemployment.
Well, this is stimulus driven. So both on the spending side and supporting stock market. So you're getting, no one stopped spending, but spending has gone down a little bit, but not as much as it could have. So lower wage earners are spending money on, apartments, their house, Netflix, everything, all the essentials, and they've been supported in this. So they're continuing to do so. Higher income earners have pulled back much more because, you're buying the essentials, but plus you're buying trips to Europe or fancy vacations, things like that. So that stuff is pulled back. So there is some drop in spending there, but the fiscal stimulus has helped keep consumer spending high. And then, the Fed buying stocks and bonds is also supporting markets. So we're going to say it's, actually the increasing national debt is helping drive stocks for now. And then, then the Fed actually buying stocks and bonds keeps them up.
So along the same lines, how long can the Fed continue to support the market before negatives start to show? And what are those negatives?
So there's a theory that once you hit 100%, once the debt reaches 100% of gross domestic product, growth has to slow. And we've seen that happen coming out of the global financial crisis, happened to a lot of countries in Europe. So that's kind of a longer term issue. The Fed is essentially printing money, which if you've taken an economics class, you'd probably learned that's not sustainable thing. So at some point, you would expect that to drive inflation because the government's issuing bonds to pay for the debt, and the Fed just throws them on their balance sheet. But, they don't need to get that money from somewhere else. They just give it to the government. They're the Federal Reserve Bank. So at some point, if they were to continue to do that in good times, you would expect it to continue to, you expect the money supply to get out of control, and more money supply equals inflation. But we haven't seen that yet. We haven't seen, we should have seen inflation. A lot of people wonder why we haven't seen inflation since 08, 09 and everything that was put in place there. So we've had stimulus continuously since then, and that bumped up in the last, call it 3 years, as we cut taxes and things like that. So there's a lot of government money going into that, being put out into the hands of the public, by running bigger deficits, and it hasn't been a problem. Most of the benefits have been accruing to higher earners that don't necessarily spend all the money they have. I mean, there's a concept around called modern monetary theory, which claims that you can run huge deficits and not worry about it until it causes inflation. So, going into this, we had run $1 trillion deficit and we hadn't seen any inflation. Most of that deficit, the benefit of that deficit accrued to the highest level of income earners. You saw income tax cuts, but for people is really impacted. I think I heard 150,000. If you're making 50 to 150,000, you had an increase. Over 150,000, you were paying lower taxes, but you're not spending that money. So people that make that much money are just saving it. So that's part of the reason the stock market was doing so well. All that money went into what we call risk assets. So assets you're trying to increase your savings on. Where you could see inflation spike is if some of these benefits were accruing to lower income earners that spend all their income. So if you're, the lowest, bottom 90% of income earners, you pretty much spend all your money. So if you are getting more money, you're going to put that towards goods and services, which will drive the economy. It's a bigger growth driver, but it will also likely increase inflation. So that's obviously something that we would worry about going forward.
Since energy has dropped so much, is now a good time to invest in renewable energy? And if so, is there a renewable energy mutual fund you would recommend?
As far as, renewable energy has not necessarily dropped. So when we say the energy sector, we're looking more at oil and gas companies, and that's dropped for two reasons. One is the economy's weakened, so demand for oil and gas has fallen, which means the price is lower. But there's also the technological headwind in the fact that technology is reducing demand for fossil fuels, and it's increasing the supply of renewables, which cuts into that. It's also improving the production and decreasing the cost of production of oil. So you've got all those things going against traditional energy sector. I think that renewable energy sector doesn't really show in the traditional energy part of the S&P 500. So there's a few funds that get involved in that. But the thing is that the prices haven't dropped. So they are still very expensive. There's some private funds that invest in that area. So the investment opportunity is available, but it's not that easy to get into. So, but we do look into that, and there's a few holdings we own that benefit from the renewable energy.
Along those lines, last night, Trump promoted increased sales of autos as a positive for the economy. In the next 5 years, which industries do you think are the real positives to support economic improvement?
To support that, I think that we could see some infrastructure spending passed as far as a way to try and reinvigorate the economy as we come out of this. So I think some of the industrial sectors, that have been pretty well hit, have the potential for recovery. If we do see higher inflation, higher rates, banks tend to benefit from that environment. So, and I think the other thing you're going to see is, I didn't get into this in the presentation, but you're going to see a reduced level of globalization. So manufacturing being brought into the US, which, can benefit a number of parts of the market, not all manufacturing, but at least as far as critical components of manufacturing. So things like drugs that had been a lot of those were manufactured in China, which I don't think people want control of that, and maybe the electronic supply chain is for some of the higher end items. So there is some manufacturing benefit there too, which also could, turn around and cause higher inflation too. But I think some of those cyclical sectors should benefit as we do recover from this.
Do you have any comment on stocks with higher dividend yields or growing dividend rates?
Yeah, I think that's a great place to invest. What we like to see is a company with the ability to grow dividends, so they're not paying out all their cash flow in dividends, and have a good dividend policy. That's always something we look at, is not only the current dividend, which is important to us. Almost all the stocks we hold pay a dividend, except, with the exception of a handful of the growth stocks. But that absolute level and the ability to grow them are a big part of total return.
We have another political question. If the Democrats win the White House and the Senate money likely will be spent on necessary infrastructure, would we expect muni bonds to increase in value as a result?
If we want Senate money increase in value, well, I think there would be support from them, and there would be more issued. So the rates may go up. In fact, muni bonds are actually one part of the market that seems pretty attractive already. There's some credit concerns about some municipalities. States aren't going to be able to go bankrupt regardless of what Mitch McConnell says, but there's certainly some more concern about munis. So the yields there are actually pretty attractive. I think when we are looking at bond ladders now, it's a different equation whether you want to go into taxable corporate bonds, which are being purchased by the Fed versus munis, which still have pretty nice rates. So yeah, so if they're issuing more muni bonds, there is a chance that rates are going to continue to go up. So those could continue to be a good investment. As far as the value of the bonds increasing, that would be so a bond you already own and it increases, that would push rates down. I think that could happen, and rates could be pushed down if some of the stimulus money comes in to actually support municipalities, and help ensure they have funds to pay their bonds. So that could happen. We'll have to see. I think the Democrats are certainly be more willing to support municipalities. There seems to be some pushback on that from the Republicans, but mostly due to the Democratic states wanting money. So that's a little bit political, but yeah.
Okay, Steve, would you hazard an opinion on the survey questions?
Well, I asked you, so yeah, I didn't have to answer those. Let's see. As far as interest rates, I think the long-term picture is higher, but I don't think by 2021 they will move that much. Stocks, always harder to tell. I do think we get some more volatility towards the second half of the year. And it could depend on how the stimulus, how we come out of this next week or so on hopefully a replacement for the stimulus. I think we're going to see some drops in stocks. If I were going to hazard a guess, I'd probably say levels closer to the same than significantly down or significantly up. So I guess I'd say unchanged on both.
Okay, we have a couple similar questions here. If one were to direct more cash into our account, would you invest in stocks, bonds, or just leave it? And similar questions, why shouldn't we just cash out of everything for now and wait until 2021 to reinvest?
Or cash anything else. I mean, I think if you have cash, you want to be carefully deploying that and buy just the opportunities. I don't think you want to just go all in on the market. I think there's opportunities certainly in some of the more cyclical sectors. I think if we buy banks now, that they will eventually come out of this. It may not. We may have a little time before we see good returns on those. As far as cashing out, I still think there's good parts of the market. So mostly, we'll probably be steering more towards international and more of the value / cyclical sectors versus the S&P 500. So I wouldn't cash out, but I'd evaluate what parts of the market I was in and whether that has higher risk or opportunity. I would say, I think what I was trying to show is that the market, meaning all stocks, may seem high, but that's really the result of a small handful of stocks. So I think you want to be sure that that's not all your exposure, that you're diversified even into some of the sectors and parts of the market that don't look as attractive now because we are in a recession, and but are pricing that in and have growth potential into recovery.
Along those lines, we have a couple questions about what are your opinions about investing in cryptocurrencies or metals?
Those are good questions. So they're kind of along a similar line. I don't know if it was the same question. So gold has historically been seen as a store of value and defensive in the case of unrest, right? So I think the idea is if you have physical gold, you can go out and trade that for services. I don't know if that holds true in the current environment, but it is like a store of value outside of stocks. So I think that belief will continue to drive the value of gold. And that could hold true to cryptocurrencies too. I mean, cryptocurrencies, the difference between gold and cryptocurrencies is there's a limited supply of gold. So it's a little bit, you can keep track of it. There's not going to, they're not going to produce a lot more. So, and it's hard for cryptocurrencies to do that too. So they may have a place in this as well that could be similar to gold, but they seem to be a lot more volatile. So I'd be a little bit cautious there. But something like and I think they're still in their infancy. They haven't had that. The idea is if you could find a cryptocurrency that was one secure, so leave that, but scalable and decentralized, that could be a form of currency, but it's been hard to get. No one's done both, because something like a Bitcoin is decentralized, meaning everyone keeps track of it, but it's not scalable because everyone keeps track of it. So as the users grow, it kind of limits the growth of the cryptocurrency to grow. On the other hand, if you've got, say, a bank or something keeping track of the ledger, that gets rid of some of the attractiveness of a cryptocurrency. So, I think they could do well. I think precious metals can serve as a good hedge against this. But with the understanding that if you're buying gold, you hope it goes down, because most of your portfolio is not in gold; it's in stocks and bonds, which should do better if gold is doing poorly. But that's part of that's part of our investment in alternatives. So gold's an alternative. Consider that a real asset. So is real estate. So is infrastructure. Whether we buy natural resources, we've had commodities in there before through futures. So it's all a good. It's all a way of diversification, and I think that's the important part to look at here. Is we're not just invested in stocks or the S&P 500, which are a handful of stocks now, but there's a lot of it's a diversified portfolio that should survive different kinds of ups and downs.
How has your opinion on investing in international changed over the last few months?
Well, it's changed mostly because of the virus situation. We were actually quite concerned about emerging markets even in March. And we did reduce international, I think, late last year, based on they had not done that well. And, we continue to see strong growth in the US. It's, this is simply virus management and managing the outbreak. I mean, it's just much better in other parts of the world than it is in the US. So it's, I think it's, and there's better valuations. So it does seem like there's going to be some outperformance there, certainly on an economic basis, which, should carry through to the stocks. So that's something we couldn't have foreseen 6 months ago. I don't think we did mention coronavirus in the last economic update, but that was February, and certainly things have changed pretty dramatically since then. So
another virus-related question. UCSF doctors, as of last week, did not think we were going to vaccine our way out of this. What are your thoughts?
I don't want to debate a doctor from UCSF. So, I'm hopeful that a vaccine will work eventually. I mean, I think eventually, one way or another, we'll get out of this. I think at the very least, people just get out of the house, at some point, and try and resume some kind of life as normal. I mean, we've seen other pandemics, even the Spanish flu in 1919, that lasted a couple of years, and eventually pretty much disappeared. So I would still expect within a couple of years things will start to recover one way or another.
We have another specific question. What are your thoughts about investing in epigenetics?
Yeah, to defer. I can get back to
Okay.
Brian on that one. I don't know specific company details.
Okay. And I'm going to wrap it up now because there is a question that several people have asked, and I think it's very appropriate given the times, and that is, where are the cookies?
Well, unfortunately, I showed the slide of companies that permanently closed, and specialties is one of them. So hopefully by next year, we'll be able to do this in person. But if specialties is permanently closed and we can't find good cookies, I think we might need to make them ourselves.
That's about it for questions. So
okay. All right. Well, good. Well, thanks everyone for joining us. As always, if you have any more questions, feel free to reach out. I think you know where to find all of us. And enjoy the rest of your afternoon.
thank you, Steve.
Thanks, everyone.
Okay, thank you.
Thanks, Steve.
Thanks, Andy.